Welcome to Aristotle Money Mike Unraveler University. And our slogan is, if you give a man a fish, he'll eat for that day. But if you teach a man how to fish, he'll eat forever. So I am Aristotle. I am from Atlanta, Georgia. I have been trading options for about 4 years. I have been in the stock market for about five, a little over five. Like just learning the stock market and getting familiar with it. Basically, I started a company. I met Mike and Unraveler a long time ago. They were already doing their own thing. They were doing their own thing, but we decided to do this course together because we realized that we're three unique traders and we can offer unique perspectives from three different ways. So that is why we started this course, to pretty much have like a low costing course, but for the people, because me, Unraveler, and Mike are all people who genuinely care for the people and not really like trying to, hit people over the head with our prices. We're really just trying to just help as many people as we can learn the art of trading. Like I said, I have a wife, I have a son. I'm from Atlanta. I served the military for 6 years. I love to option trade. And right here is actually, I was at my son's baby shower in this photo. So this was what was this? This was 2018. So it was actually a long time ago. But anyways, I'm going to pass it off to Mike so he can introduce himself.
What's up, guys? Welcome to AMU University. My name is Mike, and I grew up in both Florida and New York, but I'm originally from Florida. I started learning how to trade with my dad when I was 12 years old. We would actually get like the local newspaper and just kind of review what stocks we were thinking about buying or selling. And he taught me a little bit about basic finance and all that. I opened my first account in high school, and I started trading throughout high school, and I continued to trade throughout college. I studied aeronautical science and finance, so I'm actually a pilot also. I have a private license and an instrument rating, so if you guys know anything about that, I'm also a pilot. I traded throughout college. That entire time while I was studying, I traded throughout college. I started making pretty good money my junior year of college. Okay. And then I finished college. After I finished college, I started working as a member relationship specialist at a small bank. I continued trading and saving while I was working at the bank, and I eventually made my way to New York, where I worked in debt capital markets. Um, Made some connections in the finance industry in New York, and met a group of guys who were also day traders like myself, and we decided to create a fund, like a hedge fund. So we gathered seed capital. I worked on the fund for about 6 months, but then decided it wasn't really the lifestyle that I wanted personally. I didn't want to have to report to anyone. I didn't want to have to import to investors and follow strict guidelines. So I decided to go my own way from that, and I retired in Colombia. So I now live in Bogota, Colombia, and every single day I still trade. It's my passion. I love trading. And now my goal is to help other people understand the dynamic of the stock market and achieve that same freedom that I have now. All right. So welcome to AMU University.
What's up, everyone? Welcome to AMU University. My name is Rohit, and if you're from Aristotle's chat or if you follow me on any of the social media sites, you may know me as Unraveler. I'm a 28-year-old, and I currently live in the Midwest, working as an IT consultant in data analysis, machine learning, and information systems, so basically software engineering. And so to tell you a little bit about my journey as a trader, I have to go back to my college days. I, however, always been good with numbers, and like most people, was always fascinated by the stock market. It promises great reward for those willing to take smart and calculated risks. I love the concept that you could buy something low and sell it high for a big profit. So I decided to educate myself and started trading when I was in college. which was like 7 years ago. When I first started out, I primarily traded equity, small to mid-size equity, meaning basically buying and selling stocks. So I use technical analysis to buy low and sell high, right? Straightforward. And I was pretty successful after my first 6 months of trial and error. I was making, I was making a decent amount of money. After I graduated college, I started working for a finance firm in New York City. And I was introduced to the world of options by some of my colleagues who were very successful in trading options. I started learning more about options and realized that I could apply the same technical analysis strategies that I use for trading stocks. Whatever it is we're going to learn in this course, I learned that whatever I applied for stocks, I could use the same thing and apply for options. I could risk a lot less money and make a lot more money in the process. That was very appealing for me. So I decided to focus more on trading options, and I'm happy that I did because it allowed me to grow my account immensely over the years. So the start of the pandemic, which is like last year, it's almost a year, right? Yeah. So we noticed that a lot of new people entering the market. They didn't know what they were doing. We saw a lot of people struggling. That's why the three of us, teamed up and started AMU, and we made the course affordable so that everyone could get in and get a good value for their buck. About my educational background, I have a bachelor's degree in electrical and electronics engineering and a master's degree in information systems with a focus on machine learning. So I'm very much a numbers guy, and my trading approach is very technical, but I also incorporate a little bit of fundamentals in my overall market research for swing and positional trading. I hope that this course helps everyone level up and take that next step in your trading journey and become profitable traders. We will do everything we can to help you take that next step. Good luck and happy learning.
All right. Well, let me go all the way back. Make sure everybody good. All right. Let's see. By the end of this course, you will know how to day trade and swing trade confidently, control your emotions while trading, be consistently profitable, and unlike other courses, we are giving you everything instead of the basic needs to know. So we're going to hop right into it. Basic stock market terminology. Stocks are the capital raised by a business or corporation through the issue and subscription of shares. Shares are pieces of the company that you own outright with no expiration. Buying shares make you a shareholder. So in the stock market, you have two terms, right? Bullish and bearish. Bull strike up, bear strike down. So in the stock market, someone who was a genius decided to name, and I feel like it's a genius move. It's based on the fighting attacks of the two animals, bears and bulls. So whenever I say something is bullish, it's going up. Whenever I say if I say anything with the word bear in it, that means it's going down. So a bull market is when the stock market as a whole is in a prolonged period of increased stock prices, uptrend. And a bear market is when the stock market is in a prolonged period of decreased prices, downward trend. Bulls, the buyers, is referred to as a term that gives a name to people who are pushing the prices to go up. You'll also see the term bullish, which also means prices are going up. Bears, which is the opposite. All it means is the prices are going down, right? So remember, pre-market is always 30 minutes before market open. So I want you guys to take a mental screenshot of this map real quick. And remember that at 9:30 to 4 will be Eastern time, 8:30 to 3:30, and then so on. So like I tell people, I'm jealous of the California people. But right now, I would like to know, where are you guys from? Okay, Florida, Cali, Jamaica, Duval, LA, Atlanta, Brooklyn, Charlotte, Baltimore. I see everything. Louisiana, South Carolina, VA, Texas, mostly. Okay, that's what's up. Dublin, St. Louis. Okay, cool. All right. So now that I know where you guys are from everywhere, by the way. This whole map damn near was covered in 30 seconds, honestly. Oh, and remember, 30 minutes. So like 9 to 9:30 is the pre-market. So remember, pre-market is always 30 minutes before market open. It's the first 30 minutes. So from 9 to 9:30 is pre-market. And yes, you can trade pre-market depending on which broker and all types of other stipulations, right? Now you can't do too much, but you can do limited things like buying and selling, stuff like that, especially with shares. Okay, trade. Trade is simply when you buy or sell a stock. A day trade, buying and selling a stock within the same day. Swing trade, holding a stock overnight or longer. Longing something, bullish on the stock, think it's going up. Short, bearish on the stock, think it's going down. Call, an option trade that bets on the stock to go up. Put, an option that bets on the stock to go down. Shares are pieces of the company you own outright with no expiration date. Dividends, a portion of a company's earnings that is paid to shareholders, people that own company stock on a quarterly or annual basis. Not all companies pay dividends. Volume, the number of shares of stock traded during a particular time period, normally measured in average daily trading volume. So, fundamental analysis, the analysis of businesses' financial statements, health, and competitors and markets. Technical analysis, financial analysis that uses patterns and markets data to identify trends and make predictions. So, technical analysis is what we will primarily be teaching you guys. We'll be teaching you price trend, candlestick patterns, supply and demand, moving averages, indicators, anticipating short-term move. We'll be teaching you guys so many things. I mean, you name it. Level 2, we'll be teaching you guys the indicators we use. We'll be teaching you guys the scanners we use. We'll be teaching you guys, man, you name it, we're teaching it, especially with technical analysis, because that is going to be your bread and butter for trading. You guys came here to learn how to make the money quickly, the money real fast. You guys, that's why you guys came here, right? So that's what we'll be teaching you guys how to do. In fundamental analysis, fair pricing is key. Traders are looking for stocks that are undervalued and overvalued. Extrinsic value is key. So with fundamental analysis, and remember, this is just the introduction class, right? So with technicals, that's all price charts. That's all, chart reading. And with fundamental analysis, that's when we're going to, in the course on day 5, where we're going to break down the financial statements, the spreadsheets. What else are we breaking down on day 5? That's definitely a full day for fundamental analysis. We have one day dedicated to balance sheets, cash flow statements, income statements. We will be teaching you guys that too. And I'll be teaching you guys how to diversify your portfolios, and you'll be getting an inside look at some of the stocks that I own in my portfolio, right? So I'll show you guys my 9K portfolio from like 5 years ago. Then I'll show you guys a 700K portfolio 5 years, 6 years later, right? So this is just the introduction. It gets much harder after this course. I mean, after today, I won't say harder. It's just we're going to be throwing out more information. I'm going to make sure we teach it in a way that you guys understand, all of us, right? So I'm going to be passing this off to Mike. Remember, this is day 1. We're going to be teaching a lot more. It's 12 more days to go.
All right, hey guys, welcome to AMU University Week 1, Day 1. So before I get started today, I just want to make sure everyone can see my screen and everyone can hear me well, see my mouse. Perfect. All right, so like Aristotle said, today is more of an intro day. So if you already know what I'm talking about, then maybe you'll get a little refresher. but it's also important to start building the foundation, right? So I'm going to be talking about some expectations. I'm going to be talking about plans that you have to understand and brokers to choose from. But let's go ahead and get started again. So welcome to AMU University, okay? So expectations of AMU University. Will you become rich the day after taking AMU? No, you won't, okay? It's just a fact. It is a very in-depth course. You're going to learn a lot, but you can't have unreal expectations. You can't have unreal dreams, okay? So you will not become rich the day after taking the course, but over time, if you study, if you work hard, then that can be something that you will look at in the future. But the most important thing that you'll learn from this course is focusing on trading and not actually the money, okay? Will you still need to put in work on a constant basis after taking AMU? Yes. So there will still be a lot of things that you're going to learn after AMU. This is just to jumpstart your career. This course is designed to teach you as much information possible in just 4 weeks of time, okay? But you will have to continue to put in work and continue studying and just, taking on practicing life. You have to go and take those trades and learn from the trades. Will you learn a lot and build a foundation to becoming a successful trader? Yes, that's what this course is designed for, right? So AMU is a course designed by 3 successful traders, all from different backgrounds. Our goal is to give you a foundation to becoming a successful trader, whether you're a beginner or you have been trading for 2 years. So even if you already have some experience in the stock market, this course goes above and beyond, and we go very in depth and talk about everything you need to know to get to that level of becoming a successful trader, okay? So take notes. Everyone, make sure you're taking notes and make sure you're paying attention, okay? So welcome to AMU University. So these are just some quick basics. These are the fundamentals. I want to talk about these on day 1 and also on the last day of class. So these are the most important things that I can discuss with you, the most important ideals that you can have in your head when you're becoming a trader that is going to take you to that next level and that's going to keep you consistent, okay? So trading, write all these down or take a picture. Trading less is more, okay? So we're actually, if most beginner traders like to trade a lot, right? They always like to be in a new position, taking on a new position, trading 10 plus stocks a day, but that's really not necessary. So the most successful traders actually trade less. You really want to focus on the most high probability setups, high probability trades before you enter into a position, right? So trade less, and that will equal more gains. I'll be talking about that throughout this entire course, but that is something really to think about. Focus on one high probability trade per day, all right? And then capitalize on that. And we'll be talking about how to find those high probability trades, what are the best setups, okay? But that's just something to think about right now. Trading less is more. Focus on the big picture. So when as a career trader, as a day trader on a day-to-day basis, you don't want to be focusing on your P&L today, your P&L tomorrow. It's more important to focus on the bigger picture. So are you making money, on a monthly basis? Are you making money on a quarterly basis? You will have quite a bit of swings. You will have down days. You will have really good up days, okay? But you have to focus on the big picture. And then that is, are you consistent on a month-to-month basis? Okay. Start small and build your way up, no matter the account size. So whether you're starting out with the $500 account or if you're starting out with a $100,000 account, all right, you have to start small, regardless of your account size, because it's a psychological factor. So when you're trading with less money, it's going to be easier to see those losses and to see those gains than it would be if you're trading with more money. So always start small, no matter how much money you have, okay? And then build your way up as you become more consistent. Every trade should have a plan with an action. This is a fact. So before you go to enter a trade, you should already know why you're entering the trade. So if you don't have a reason to be entering the trade, if there is not a high probability reason as to why you're going to enter that trade, then you have to think twice about if you actually should be entering that trade. So before you go enter into a trade, make sure you have a plan, all right? Make sure you know where you want to get in. Make sure you want to know when to take profit, right? When you should start taking profit. This is just all stuff to think about, okay? Focus on the stock with the highest volume, clearest trend, and most aggressive buying or selling. So this is the biggest point right here, okay? And I'm actually going to be mentioning this like 15 times throughout the course, all right? When you do this, when you focus on the stock with the highest volume, clearest trend, and most aggressive buying or selling, then that's when you're going to find those high probability plays, okay? Now, it may not make a lot of sense right now. Like maybe you don't know what volume is, maybe you don't know what trend is, maybe you don't know what aggressive buying or selling is, but I just want to say it on day one, because when I go to talk about it more throughout the course, you'll always be thinking about it in your head. So write it down now, take a picture, whatever, and then always be thinking about that as I start explaining volume, as I start explaining aggressive buying and selling, okay? But these are just the quick basics, the fundamentals as to how you can become a consistent trader, all right? So let's go ahead and start out by talking about cash versus margin account. So every single trader, when you go to open a brokerage account, right? When you go to open, whether you open a TD Ameritrade account, if you open an E-Trade account, if you open whatever, on whichever broker you're thinking about considering, they're always going to ask you, would you like to open a cash account or would you like to open a margin account? So what is the difference? A cash account does not have a restriction on how many day trades you can make, okay? You can trade the funds available in your account until they are no longer available. Shares take 3 days to settle, while options settle overnight. After the cash is settled, you may trade with those funds again. All right, so this is just an example of a cash account, right? Let's say if your account has $1,000 in it and you buy an Apple call worth $300. You now have $700 to trade with for the rest of the day. The next morning, the profit or loss you took on the $300 Apple call will be ready to use again. All right, so think about that. You have $1,000, you buy an Apple call worth $300. Let's say you make $50 profit on it, right? And you day trade it, you sell it, right? And now your account has $1,350. The next morning, you can now trade that entire $1,350. But on day one, since you only used $300 of your account, you can still trade the other $700 of your account, okay? So that's the cool thing about cash accounts. You have no restrictions on how many day trades you can make. There's no regulation, but you can only trade the money that's available in your account, okay? Margin accounts under $25,000. So if you open a margin account and you have less than $25,000, you will be restricted. It's a law, right? It's a regulation by FINRA. You will be restricted to 3 day trades within a 5-day period. Okay. So 3 day trades, you know what a day trade is? That's buying and selling a stock, right? Aristotle just said it. It's buying and selling a stock or buying and selling an option on the same day. So, you know, if I buy an Apple call at 9:30 a.m. and I sell it at 2 p.m., that's a day trade. Okay. So if you open a margin account, you have less than $25,000, you will be restricted to 3 of those within a 5-day period. If you open a margin account, but you have over $25,000, you have unlimited day trade. So you can day trade, you can buy and sell stocks, you can buy and sell options all day long if you want to, okay? Margin accounts also allow you to borrow money in order to leverage positions, right? So you're borrowing money on margin. So for example, TD Ameritrade, which a lot of you guys should know, Thinkorswim, has 4 times margin on equity or shares. So what does that mean? Let's say your account balance is $25,000, right? You have $25,000 in your account. you could actually enter into $100,000 equity or stock position on margin. So you could day trade with the $100,000, which is 4 times your account size. And you're just trading that on leverage, okay? So which is better and why? Very simple. If you have less than $25,000, you need to open a cash account. It'll allow you to day trade more, okay? So less than $25,000 in your account, open a cash account. If you have over $25,000, I recommend a margin account because you can day trade unlimited, okay? So that's the difference between those two. Does that make sense? Perfect. So let's look at brokers now. So I'm going to start with TD Ameritrade because it's one of the most popularly used brokers by retail traders. Okay. It's also called Thinkorswim. If you guys know it better by Thinkorswim, it's TD Ameritrade Think or Swim. Okay. TD Ameritrade Thinkorswim allows you to open both cash and margin accounts. All right. So if, like I said, if you have less than $25,000, open a cash account. Okay. It's called individual cash. You can trade both options and stocks. Okay. Very cool. You can trade equity. You can trade options. It is a really cool platform, and I'll actually be doing an entire day on just where I go over the Thinkorswim platform, and I'm going to show you guys all the cool features. Right? It's a very nice interface, and it's free. The platform is free when you open an account. They also have a mobile app, which is easy to use. They have $0 commission fee for stock. So if you're planning to buy and sell shares of stock, then you actually get a $0 commission fee. You don't have to pay commissions if you're just buying and selling shares of stock. They have variable commission for options depending on your account size, but it usually starts at 65 cents per option contract. So it'll be 65 cents commission to buy and 65 cents commission to sell an option contract. But you can actually get that reduced a lot if you message the support desk and you ask for them to reduce your commissions. Usually they will bring it down to 50 cents or so. The only excuse me one second, I'm going to drink some water. So the only problem with TD Ameritrade Thinkorswim is that they have actually been declining in speed and reliability a little bit since 2020 when they went commission free. But it's not a huge problem after the open. It's usually just like the first 5 or 10 minutes. Customer service sometimes is also a little slow and not helpful. So like if you call them, sometimes, sometimes it'll take 45 minutes for them to actually pick up the phone. So that's not, it's not the best customer service. But overall, it's actually a really great broker and it's a really great platform. So I do recommend, and I'm going to show you now what the actual setup looks like. So this is what the TD Ameritrade Thinkorswim setup looks like. You can see how I have it set up here to where it shows a lot of different stuff. So you can see over here on the left, I have a little live news. I have a watch list. And by the way, I'm actually going to be doing an entire live presentation on how I have this Thinkorswim set up. So it's not, you don't have to worry about what all this means right now because I'll be going over it in depth, actually how to set it up like this. But this is how I have it set up, okay? So you can see chart right here. This is the actual chart for Tesla. You can see at the left right there. This is an active trader. So this is how you can buy and sell out of positions very quickly. and I'll be going over how to set that up. This is a times and sales. So this is actually the live order screen of how you can see the executed shares. Okay. And then down here at the bottom is level 2. And this is the pending order book. All right. So I'll be talking about all of this and what all of this means. But I just wanted to show you what the platform looks like. So this is what the Thinkorswim TD Ameritrade platform, desktop platform looks like. All right. Another great broker for beginners to get started on is Tastyworks. I do hear a lot of good reviews about this one. It has both option stock trading, great execution and customer support. Platform is a little basic and confusing to some. Okay. That's what I've gone on and I've played around on Tastyworks before. It's a little weird, the platform, and it's also a little basic, but I've heard that it has great execution. Okay. So you won't have any problems getting your orders filled. And then the commission isn't bad. So it's $1 per contract on option commission, and that's capped at $10. All right. So the commission isn't that bad at all. But overall, Tastyworks is another good starter broker. But I want to focus primarily on TD Ameritrade and Thinkorswim. TD Ameritrade, Thinkorswim, and Lightspeed, which is the broker that I use. So Lightspeed Trading, this is the broker that I use. It's really amazing, beautiful platform with access to level 2 and times and sales. Has a short locator to locate hard to borrow stocks to short. The execution is direct to market. So you can actually click and choose on which exchange you want to route your order. And I'll be going over what that means. But you can route your orders to wherever you want. You can hide your position. You can hide how many shares you're in. So execution direct to market never has lag or problems entering, exiting a trade. So I never have I start trading at 9:30 a.m. as soon as the bell opens, and I've never had issues getting in or out of a trade. So that's really nice. I mean, it just never has that lag that a lot of other brokers have. You can route your orders to ECN you choose. I just talked about that. So you can actually choose which exchange you want to trade on. Sorry, guys. It's 60 cents per option contract. That's the commission. So it's 60 cents in, 60 cents out. And then it's 0.004 cents per share that you're trading. So it's not terrible. But Lightspeed is actually designed for professional traders. They don't want a lot of new traders using their platform because they want to have the best customer service and the best execution. So the account minimum is actually 25,000. That's fine if you can't start on this, but I would look forward to using it at some point. Okay. And this is what my platform looks like on Lightspeed. Okay. So this is what my actual execution looks like. Up here at the top left, you can see this is the level 2. So this is the order book for Tesla. You see right there, Tesla at the top. This is the actual NASDAQ and ARCA books I look at. So this shows you where there's pockets of buyers and sellers, which I'll be going over way more in depth later. But you can see like at 718, there's a pending buyer for 2,572 shares. All right. But this is the actual pending buyers and sellers. This is the NASDAQ and ARCA books. I have my times and sales, which I'll be talking about. My order entry. So if I want to buy equity, there's no confirm or send on Lightspeed. It's very fast. So I just click on the ask. I take 1,000 shares and I click buy, and it'll pop up here where it says orders and positions, and I can get in and out of trades really fast. There's also right here, which is where I can trade my options. So if I want to trade Tesla 720 call, I'll just put that in here, quantity, price, click buy, and boom, I'm in. All right. So it's very fast. It's very professional broker and platform. So I do recommend. And up here, I have orders and positions. So orders shows the orders that I got filled on, and positions obviously will show the positions that I'm in. Okay. And then just a nice little chart down there at the bottom just to make sure it's in line with my trading view charts, which is what we use for our charting software, okay? But this is Lightspeed. Highly recommend it if you have over 25K. Execution is really fast, okay? Robinhood is another popular one by retail traders. It's a very simple user interface. You know, if you're looking to swing trade, then it's not a bad platform. But if you're looking to day trade, I highly recommend not day trading on Robinhood, okay? It's just really slow. So it's $0 commission fees on stocks and options. So that's why I say if you're looking to swing trade, then maybe take a look at Robinhood, okay? Because it's $0. You don't have to pay commissions for stocks and options. But the problem with Robinhood is that they have horrible customer service and horrible execution and lag. So there's actually shirts that were made that say I survived the Robinhood crash of March 2019 because Robinhood just didn't work for an entire day. So, you know, a lot of people lost a lot of money because the platform, no one could access their brokerage account. No one could access their app, okay? So Robinhood just didn't work for an entire day. And their response to that, I think they gave gift cards to people, like Walmart gift cards, all right? So it was just a really bad thing that happened, and there were literally shirts that were made that say I survived the crash of Robinhood, right? It is really popularly used by retail traders because it's so easy to use and you don't have to pay commissions, but I do not recommend it for day trading, okay? Bloomberg Terminal is another one. This is actually used just for primarily used for, it's a news platform, okay? So it's the most advanced and elite platform in the world. I mean, if you walk into any hedge fund in New York or London, whatever, you're going to see people using Bloomberg terminals. It provides live news before any other source. So they actually create the headlines. And I'll be talking about how news is so important in the stock market. But they actually create the headlines, okay? So they create the news that you can then react to the stock market on, okay? It's in-depth market data and company information. There's just so much you can do research-wise on a Bloomberg terminal, but it is expensive, right? It's 27K a year. So, you know, if you're not if you don't have that type of income, or if you're not a professional trader, then just forget about it. And I'm going to show you guys a lot of other really solid news sources that are free. All right. But so there's a lot of other brokers, you know, there's a lot of other brokers. People also talk about Webull. Webull is pretty much on the same level as Robinhood. It's not bad. I wouldn't use it to day trade though. Day trading, I would really focus on Thinkorswim, right? TD Ameritrade, the first one that I went over, or Lightspeed if you have over 25K. There's a lot of good brokers, but there's also a lot of really bad ones, okay? Focus on, if you're new, I would start with that Thinkorswim. You know, I would start with TradeStation is a good broker. So there's a lot of good brokers, but you know, just focus on those ones that I talked about. If you have over 25K, go for Lightspeed. It's a really solid broker, okay? So just a quick little summary of fundamental analysis. This is just to kind of get it in your head. I'll be going over an entire day though on how to break this down. So fundamental analysis is the stock market analysis of breaking down a company's financial information to find intrinsic value versus market value. It requires an in-depth study on a company's past performance, present performance, and future expectations. Yahoo Finance provides a great rundown on every company's financials and balance sheet. So you can see up here at the top, I have an income statement. This is straight from Yahoo Finance, and I'll be going over how to read this. This is just a little part of it. There's a lot more to it, but you can see here total revenue, right? So this is an annual income statement because each one of these you can see is 2016, 17, 18, 19. It's an annual income statement. But I'll be talking all about fundamental analysis, how to find undervalued companies that you can buy on a dip, okay? And Yeah, so that is all I have for today. Again, it's more just kind of an intro. Sorry about the coughs. Actually, I have COVID, but I'm going to power through and make it through this AMU. I'm excited for this month. Hope you guys are excited. Hope you're taking notes and just focus. All right, take notes, guys. So I'll be passing it off to Unraveler now.
Thanks, Mike. What's up, everyone? Welcome to day one of AMU University. Hope you guys are having a good first lesson today. So before I get started, I want to make sure that you guys can see my screen and my laser pointer, the red laser pointer. If you guys can just type yes, I could know. Perfect. All right. So today's day one, and like the guys mentioned, we are going to talk about some basics. So I'm going to give you guys an introduction to options trading today. So let's see what we're going to learn today. So the table of content for today's lesson. First, I'll be giving you all an introduction to financial instruments. So what is it? And we're going to learn a bunch of things there. And then what are options? Characteristics of an option contract. So if you already know about options, some of this may be a refresher to you. And then we're going to learn about the different types of options. So once we're done with the basics, we'll learn a little bit of an advanced concept called as a writing options. So writing or option selling, we'll go over some basics on what are the advantages of doing this and how it can benefit you as a trader, right? And then lastly, we'll go over the advantages. Why do we trade options? Okay, so we have a very action-packed lesson. So regarding my teaching format, you can type in your questions in the chat. I'll keep an eye on it. If it's relevant to the slide, I'll do my best to answer it then and there. If not, I'll answer it at the end of the lesson. Okay, let's get started. So, financial instruments. What is an instrument? They are a means to an end. So if you're going to make music, you need a musical instrument, right? So if you want to play something, you need a guitar or a piano or something like that, right? So that's an instrument. If you want to watch a movie, you need a television set, or you got to go to the theater or the movie theater, right? So similarly, to transact in the financial markets, you need a financial instrument. What does that mean? A financial instrument is nothing but a financial contract between interested parties. So any transaction, let's say you go into a store, right? There's going to be a buyer, there's going to be a seller. Those are the two interested parties. And to complete a transaction in the market, you need a financial contract, and that's what we call as a financial instrument. Okay? It's just a technical term, right? And all financial instruments can be created, traded, modified, and settled, right? So you can create a financial contract, you can trade that, meaning you can exchange that financial contract, meaning a call option or a put option or a stock, right? They're all instruments, right? You can modify them and they can be settled, right? You can buy and sell, you can complete that transaction, right? In a nutshell, financial instruments are means to exchange money in the market, right? So there is a contract, it can be a stock, it can be a bond, it can be an option contract, it can be any derivative, right? Whatever it is, right? They are just a means to exchange money in the market. Okay? Now, financial instruments can be either cash instruments or derivative instruments, right? There are just two types. So what are cash instruments? Cash instruments are those that the markets value directly, right? So let's take an example, stocks. Stocks are considered as cash instruments. How do you say that, right? So we say that cash instruments are valued by the market directly. Let's take a stock, Apple, right? Everyone knows Apple, right? It's one of that they produce phones and there's a big company, right, with a large market cap. So Apple, the stock price It can be one, I don't know what the price is, 125, 130, wherever it is, right? I think it was close to 135 last time I checked, right? So whatever it is, right? Apple's stock price is determined by the market. So the market is going to factor in various things. It's going to see, hey, what is Apple's earnings? What is Apple's revenue? How much did they spend? What is their operating margins, right? What are their operational expenses? What are their future plans? They had an event today. So what is the Apple's projection of growth the next 2 or 3 years? Are they going to retain their market cap, or are they going to lose some to their competitors, right? So there are various factors, fundamental factors, right? The market is going to price in all of those variables, all those different variables, and they're going to value the stock price, right? So stock price in the end is based on supply and demand, but the supply and demand is created by the market. The market is going to determine that. That's why we call that as cash instruments, because the market decides the value. Okay. Now, the second type of financial instrument is a derivative instrument. Now, this is what we're going to focus on today. We're focusing on derivatives. So derivative instruments are those that derive their value from movements of an underlying entity, such as a stock or a bond, and so on and so forth, right? Now, I'm going to read this again. Derivative instruments are those that derive their value from movements of something else. It can be a stock or bond or whatever, right? Example is options, future contracts, and so on. So what do you mean by that? So when I said that cash instruments, the market values directly, derivative instruments derives their value from something else. So for example, if you're trading option contract, stock option contract, right? So Apple, the stock, let's say Apple had an event today and the market really liked that event, which it didn't. Let's assume that it did, right? And the Apple stock price just had a big rally. It ran up like 5% or something, right? Now, if you had Apple call option contracts, right? I'm just going to say. So these call option contracts are going to derive their value from the Apple stock price, right? If Apple stock goes up, the value of your option contract is also going to go up, and vice versa, right? So derivative instruments just derive their value from something else. So they don't have any value of their own. They depend on movements of the underlying stock or bond or other instruments. Okay. Those are the two different types. Cash instruments are derived by the market. Derivative instruments, they don't have any value of their own. They derive their value from something else. Okay. Now there are more classifications, but on a high level, these are the two that you need to know in the markets, right? So there are stocks and there are derivatives. Okay. Does everyone understand this first slide? Perfect. You guys can keep typing. All right. So I'll keep an eye, and if something is, if you have any questions, I'll do my best to answer it. All right. So now let's go to the fun stuff. What are options? Right. So option is a derivative instrument that specifies a contract between two parties for a future transaction on an asset at a set price within a specific date. Okay. Now, this is a complicated definition. If I just read it, you will not understand it. So I'm going to just go over an example. Okay. We're going to go over a real life example and see what an option is. All right. So let's say there are two friends, Barry and Sam. They're best buddies. Okay. Now, Sam, this guy is a reseller. Let's say this guy, he buys sneakers, he tries scalp sneakers from all these websites when they drop, and he resells them for a higher price, for a profit elsewhere. Okay, so that's this guy's hustle. That's what he does. All right. Now, Barry, since this guy is friends with Sam, he's really interested in this one Nike sneaker. All right. So he really likes the sneaker, and but he does not have the cash to pay for it now. Right. So what he makes a deal with Sam. So he writes a contract. They both get into a contract Barry's saying that, hey, I'm going to buy the sneaker I want to be able to buy the sneaker from you for $300 by the end of September. Okay, so that's the deal. Now, if I just put it into terms, right? An option is a contract that gives the buyer the right, but not obligation, to buy or sell the underlying asset or security at the agreed price within the agreed time. So in this example here, right, Barry wants to buy the sneaker. Okay, so that's the contract. The underlying asset or security is the sneaker. So in the real world, we're going to talk about stocks. So replace the sneaker with a stock. Apple, Amazon, Netflix, Google, Tesla, right? Whatever it is, replace that with a stock. There is always an agreed price. Okay, so we call this agreed price as strike price in the world of options. In this case, the agreed price is $300. Okay, so Barry is saying that I'm going to buy the sneaker from Sam for $300 by the end of September. And there is also a time constraint. So the agreed time in this scenario is end of September. Okay, so essentially, this is just a financial contract between two interested parties for a transaction on a fixed asset. In this case, it's a sneaker for a fixed price within a fixed time period. Okay, so that's an option. Now you may ask me, you may have a question. What is the point of this, right? You may just say, hey, why can't Barry just wait for a month and buy the sneaker, right? What's going to happen, right? Why is he complicating this process by getting into a contract? So if you just want the stock, why can't you just buy the stock? If you want to sell the stock, why don't you just sell the stock? So that's where this is very advantageous trading option. So I'm going to tell you why. So let's imagine, right? This sneaker is currently at current market value. It's valued at $300. Now let's say 2 weeks from now, LeBron James or some big basketball player decides to wear this sneaker, right? He says that this is the best sneaker ever or something like that. I don't know, whatever it is, right? He wears the sneaker and the demand for the sneaker shoots up. So instead of $300, people are buying these sneakers out, like they're buying it dry from all the stores. And they're selling it for $600, right? So the demand for the sneaker, just all based on supply and demand, right? If the sneaker is selling hot, it's going to cost you more to get it. Just like how the PS5 is rare, right? When it came out, a lot of people, everyone wanted it. You can't buy it from anywhere, so you have to overpay someone else, some scalper to get the PS5, right? If you couldn't get it. Same concept applies here as well, right? So the value of the sneaker just shoots up. Now, that's where Barry is very smart. He somehow knew that the value of the sneaker is going to go up, so he got into a contract with Sam, right? So he made a deal that no matter what happens to this particular sneaker and before September, I have the right to buy it from you for $300. So this sneaker goes up to $2,000. Barry still has the right to buy it for $300 by the end of September, no matter what. Okay? Now you guys can kind of understand how this is going to be beneficial in the world of the stock market, right? Stock prices always going to fluctuate. It's going to go up, it's going to go down, it's not going to stay the same way, right? It's not going to stay the same place, right? So if you can predict where the stock is going to go next, right? Using technical analysis, fundamental analysis, and a whole bunch of other things that we're going to discuss in this course, right? You can buy an option contract and hold that contract. And if the stock moves in your favor, you know that options are derivative instruments, right? If the stock moves up, the value of your contract is also going to move up. So if your value of your contract is just $100, by the time this goes up, your option contract is also going to gain value. So someone asked me a question. If Barry enters to buy it at 300 and the price might go down, can he back out at a $0 loss? So again, I'm going to read this again, Ryan. An option is a contract that gives the buyer the right, but not obligation. Okay, so this is the cool thing about option is it's just an option contract for you. It's an option, right? So guys, if you're typing a question, make sure that you're setting it to all panelists and attendees, or else other members cannot see your question. Okay, so anyway, in this case, right, Barry can in the last minute back out and say that, hey, I don't like that sneaker anymore, so I'm just not going to buy this, right? It's just an option contract. He has the right, but there is no obligation to fulfill this contract's purpose, right? You can buy it or you cannot buy it. It's up to you. Okay, so when we are day trading options or swing trading options, right, we don't actually end up buying the stock in question. So what we do is we do our technical analysis. We try to predict where the stock is going to go. So we think that if the stock is going to go up, we buy call options. Okay. If we think the stock is going to go down, we buy put options. And if the stock moves in our favor, our option contract, because it's a derivative instrument, is also going to move up, right? So we can sell it at any point and secure our profits. Okay. Now, if the stock moves against this, so that's Ryan's question. If the stock moves against you at all, if the stock moves against you, right? So what's going to happen is you can take a small loss, but you don't have to actually end up fulfilling this obligation and purchase the sneaker. Okay. It's a very convenient option, and we'll learn more about it in a few slides when I explain you guys call and put option. So another question from Chrissy. If he buys until September, right? When does Barry actually receive the financial profits? And wait until September or when the contract is over? So that's a good question. So there are two options here. Barry can, purchase the sneaker whenever he wants by just executing that contract, right? He does not have to wait until September to actually buy the sneaker, right? So let's say 2 days from now, the sneaker's value double, right? So Barry can just exercise his contract and buy the sneaker for $300 2 days from now. The second case is our day trading case. What Barry can do is, since this guy has this contract, right? He can sell this contract to, let's say, another friend, Jill, right? Barry has a friend called Jill. He can sell this contract to Jill. So once Jill has the contract, Jill will be dealing with Sam directly. Okay. So those are the two cases. Now, as day traders, what we're going to do is we're not going to focus on buying the sneaker. We're just going to resell this contract to another player in the market and for a higher price and secure our profits. Okay. Does that answer your question? Does everyone understand that? So that's what we're going to do. We're not actually going to buy the stock, right? We're not going to actually buy the stock. We're just going to resell this option contract at a higher price and secure that profit, right? That's what we're going to do. Can Sam ever cancel it? No, Sam signed this, whenever he wrote that option contract, he cannot back out of it. He has the obligation to fulfill, right? He cannot back out of this deal. Once he wrote this contract, it is set in stone. Okay. All right. So I hope that was a good introduction. And don't worry if you don't get it. We'll be talking about this throughout this course. And we'll be going over a lot more examples later on in this lesson as well. Okay. So key takeaways. The option contract buyer pays for the right to complete the transaction, but is under no obligation to do so. Hence the term option. Barry can buy the sneaker. Barry can back out of this deal as well. So that's why we call it as an option. Okay. And there is an agreed price. All option contracts will have an agreed price. So this is the price at which the option buyer can buy or sell the underlying security, also known as the option strike price. So in this case, $300 was the price of this sneaker, was the strike price, and that's the price in which Barry can complete this transaction. Correct. Amanik. Yeah. So you can do both things, right? You can make money off of this contract. You can also buy the stock itself. So there are two options, right? We'll go over it. Don't worry. You are on the right path. You guys are understanding. Okay. Now, agreed time. This is the expiration date of the option contract, and option buyer has the right to exercise their option by this date. Okay. So hope this was a good introduction. All right. Going to move on to the next slide. So now we're going to talk about the characteristics of an option contract. Okay. So there are a few terms that we'll use throughout this lesson and this course, right? So some of them you may already know, some of them maybe like Greek to you, right? So we want to make sure that you guys know the basic terms and what they imply and what they mean. So I'm going to go over a few important terms. So it'd be great if you guys can take notes. Okay. So first one is strike price. All stock option contracts can be associated with a strike price. This is the price at which an option holder can either buy or sell the underlying security, depending on the type of option contract. So if it's a call option contract, you can buy the security. If it's a put option contract, you can sell the security. And the $300 example that I gave you, right, in the sneaker, that is the strike price. Okay. What if the option buyer doesn't want to buy the contract? If you don't buy the contract, you can't trade options. I mean, like you have to buy the contract. So if you want to trade option trading, right? So if you're day trading Tesla today, I think the Tesla stock is going to go up. So I have to buy call option. So let's say I buy it for $100 and the stock actually goes up. Now my option contract is worth $200. So I made 100% return. I can sell it to someone else in the market and make a profit. So that's option trading. We have to trade the contracts. That's how we make money. Okay. All right. Next is contract size. So this refers to the fixed unit of shares that each option contract holds. The contract size for a stock option contract is standardized at 100 shares. So what this means is when you buy one contract, right, that is equal to 100 shares. Okay. So what that means is for each option contract, the option buyer reserves the right to buy or sell 100 shares of the underlying security at the strike price specified by the expiration date. So I made things simple by saying one sneaker, right? But in the real world, if I say one contract, right, call option contract for Apple, what that means is if you decide to exercise that one contract, right, it gives you the right to buy 100 shares of Apple. Okay, one contract is equal to 100 shares. Okay, now stock option contract sizes are defined by the options exchanges. So this is very important. So in the US, right, in the US stock market, the Chicago Board of Options Exchange determines what the standard contract size is going to be, right? So in the US, it's standardized to 100 shares. One option contract is equal to 100 shares, right? But if you're trading from somewhere else in the world, let's say you're trading from the UK or India or Australia or wherever it is, right? That respective country is going to decide what the fixed contract size is going to be. So I've seen countries where the one contract is equal to 75 shares, right? So it can vary. So, but in the US, if you're just going to trade the US markets, just know that it's just 100 shares. How do you find people to sell the contract to? Amar had asked me the question. So that's what Mike I think he briefly showed you, right? You saw level 2, right? You saw buyers and sellers. The market is full of people who are buying and selling like all the time, right? So for everything that you buy, there will always be someone that is willing to sell it to you. That's when the transaction happens. So you don't have to worry about how do you find people. That's what the broker application is going to do, right? So your broker application is going to act as matchmaker and is going to complete the transaction. What about low volume stock? So if you're trading such a low volume stock, then you should know that there are not a lot of buyers and sellers out there. So you may run the risk of not being able to sell at a very good price, right? So even the lowest volume stock, you will be able to find some kind of seller out there, right? So realistically speaking, okay. Anyway, so next term here is option premium. All right. So option premium is the price you must pay to purchase an option contract. So I told you that you can buy a contract and this and that, right? But you actually have to pay a certain price to buy an option contract, right? Someone asked me, so do I actually have access to 100 pairs of shoes? If you exercise that option, yeah, you do. You can actually buy 100 shoes. I don't know what you're going to do with it, but you can buy 100 shoes if you want, Christopher. Anyway, so option premium, right? So option premium is the price you pay to purchase the option contract in the first place. So option premiums are quoted on a per share basis. That is, the option premium needs to be multiplied by 100, right? Okay. So let's take an example. Let's assume that the premium for Apple $120 call option is $225, right? 2.25, right? So what this means is the buyer will have to pay 2.25 into 100, that is $225 per option contract. So if you open your brokerage app and go to an options chain and search for a call option contract, you will notice that it is represented by a decimal number. Now, this does not mean that you just have to pay $2.25. Every option contract is quoted on a per share basis. Remember, I told you that every contract holds 100 shares, right? So you have to multiply the premium by the lot size. In this case, the lot size is 100, right? So 2.25 into 100 is $225. So to purchase a call option contract, you have to pay $225. Okay? Does everyone understand this? So option premium is quoted on a per share basis. In your brokerage app, it's going to be a decimal number, and every contract holds 100 shares. So you have to multiply that by 100. Okay? It's a fairly easy concept. All right. All right, so far we've seen strike price, contract size, option premium, and the last detail is expiration date. Okay. I told you every option, no matter what it is, has a time constraint. We have an agreed time, right? We have an agreed price, that is the strike price. And we have an agreed time, that is the time constraint. What that means is every option contract, it does not go on forever, right? There is a fixed time period where it is applicable. After that, it expires. Okay. So expiration date is the day the option contract expires. Okay. Most stock options have weekly, monthly, and quarterly expiration dates. So on option expiration date, right? Option buyers will have the following choices. So all of us know that after that expiration date, that contract is null and void. So if you decide to hold a contract until the expiration date, right, you have the following options. You can sell the option contract to another buyer in the market and realize profit or loss, right? So if you have an option contract and you see the stock going in your favor, you're going to sell it to another player in the market and just book your profit or loss if you are down on that position, right? Next, if you really decide that you want that sneaker or stock, right, you have the right to exercise your position. So you can exercise your option contract to purchase shares of the underlying security and realize profit or loss, right? Let's say you decide that you want that stock, you really like that stock at that price, so you can actually exercise your contract and purchase shares based on the strike price. Okay, so that's option number 2. And the other option, the last option, which is something that you shouldn't do or try to avoid, is let the option contract expire worthless. So in this case, let's say you bought $225 option contract for Apple, $120 call option, and you decided to hold it until expiration date, right? So if the stock moves in your favor and it has some value, you can sell it to another player in the market. But if Apple actually tanked and it's currently at $100, right? So it's very out of the money, so it's going to be worthless. So you're probably going to lose everything, all this value in this contract, and it's going to be worthless. So you have to expire this contract. You have to let this contract expire worthless. Okay. If it's less than 100 shares, does that mean it's not a contract option? All option contract is standardized at 100 shares in the US. So one option contract holds 100 shares. Okay, so that's just fixed. There's no bargain or adjustments or whatnot. It's fixed. Okay. How do you actually exercise the option contract? So there is an option in your brokerage account that says exercise this option. You have to click that and follow the steps there. Okay. Anyway, all right. How was the premium value formulated? So we'll go over that, Roy. We'll go over that later on in the lesson. And I think in lesson 6, I believe I'll go over the Greeks and teach you exactly how the premiums is calculated. Okay. Does everyone understand these basic terms? Okay. Yes. Perfect. All right. So now we're going to cover a little bit more. I wouldn't say it's that important, but it is important if you are going to exercise your option contract, right? So there is something called as break-even price. Okay. So the break-even price is the price level the stock must break above or below by expiration date for the option holder to realize profits or loss. Okay. So let's say you have an option contract, and let's say you think that you really want to buy that stock, and you think that if you exercise this option and actually buy that stock, you think there is good value. I don't know what the reason is. You may think that the stock may go up a lot in the future, so you decided to exercise the contract and buy the shares, right? So there is a concept called as break-even price that you must look at and consider before exercising any options. So what does that mean, right? So let's say AMD, right? AMD is a semiconductor company that produces chips and graphics card, right? So currently, let's assume that AMD is trading at $40. Okay, the stock price is $40, and you decided to buy the $42 call option contract for $1, meaning $100. So you bought one $42 call option for $100. Okay. Now I'm not going to go over this formula here. You will understand this soon enough. But you bought one contract for AMD for $100. Okay. Now on options expiration, let's say AMD is currently trading at $43, right? And you decided to exercise your contract to buy 100 shares of AMD at a price of $42 per share. Okay. So just to drill down this point, right? You have the $42 call option. AMD rallied from $40 to $43. It gained $3 by expiration. Since you think that AMD has a lot more potential in the future, so you decided to exercise your contract and buy 100 shares of AMD. Since you have the $42 call option, you have the right to buy it at $42 per share. Okay. So one contract, 100 shares, strike price is 42. You bought 100 shares at $43 per share. Okay. At $42 per share. Okay. So your position, so you have 100 shares of AMD right now, will be 43 minus 42. That is the current price of the stock minus your average price into 100. So your position is $100 in profit at current market value, right? So meaning this is unrealized profits. So you have not sold it. You have a stock that is currently up by $100, 100 shares that is currently up by $100. Okay. but the premium you paid for the option contract in the first place is $100. So you actually paid $100 to buy this call option contract, right? So your position is up $100, but you paid $100 in the first place. So the net profit or loss is profit is $100 minus the premium paid, so $0. So you broke even on this trade, right? At current market value, you're breaking even. So you might want to ask yourself this question. Is this really worth it to exercise this option contract? You could have just gone in and bought it at $43 per share at current market value and sold your option contract to another player in the market, and you would have made the same money, which is nothing, right? So in this case, you barely broke even on the trade. So there is no reason for you to exercise this option contract. So to break even, the stock price must be at break even price, that is 43. Okay. All right. I'll explain this again. Don't worry, Shakil. Okay. So the break even price for call option is strike price plus the premium paid. The strike price is $42. The premium paid is $1. Okay. So to break even on a trade, you will have to be, the stock must be at least at $43. All right. Yeah, this is a concept that may confuse you. I'm going to go over again so you guys will understand it. Okay. So to break even on this trade, you will have to get the break even price. That's $43. So I'm going to go this example again as quick as I can. You decided to buy a call option contract, $42 call option contract for $100. Okay, that's step number one. All right, you're going to buy one call option contract, $42 call option contract for $100. Okay, AMD is currently at $40. Now let's say after a week, right, your expiration date comes and AMD actually rallied $3. From $40, it moved to $43. Okay, now you as an investor, you think that you want to exercise that contract and buy 100 shares of AMD at the strike price, which is $42 per share. Okay. So currently you have 100 shares of AMD with an average price of $42 per share. Okay. So you have 100 shares of AMD at $42 per share. Does everyone understand until this point? I want a yes. All right. You have 100 shares of AMD at $42 per share. Okay. Now currently the stock price of AMD is 43. Okay. Meaning your position is already $100 up. You have $100 shares, and every share is up $1 per share. So you have your position is $100 up. Okay. The point here is when you bought this option contract, right? You paid $100. Okay. Your position is up $100, but you paid $100 to open this contract. You got to buy this contract. So you broke even on this trade. So if you subtract your current position in AMD minus the premium that you paid, you broke even on that trade. Now think about it. To realize profits on this exercising, right? The stock must be above the break-even price. So let's assume that the stock is at 45 right now instead of 43, right? So 45 minus 42, that is 3, that is 300, right? So if your position is $300 up, and your premium is $100, 300 minus 100 is $200. It will be worth to exercise that contract. Does everyone understand that? So when the point here is, if your position is just breaking even, right, there is no need for you to exercise your option contract. Why would you want to exercise something when you're just breaking even on a trade, right? You can just sell this option contract to another buyer in the market and just buy the stock just like you normally would, right? Just buy the stock from the market. Why do you want to exercise that contract? Now, in certain cases, you may be very lucky, right? Let's say this guy, you all of you know that GameStop guy, right? Roaring Kitty. Roaring Kitty had, I think he had $13 call option contract for GME, right? That expired last Friday, right? GME, GameStop was trading at $160, right? So that guy decided to exercise all his contract at $13 per share. So he exercised, I think now he has 200,000 shares. So he exercised 150,000 shares of GME at $13. So he bought 150,000 at $13 per share. So he got all those contracts. Now that is actually worth it because today GME actually rallied 10, 20, 15%, right? Now, if you believe that the stock is going to go up and you have a very, very low strike price, right? It makes sense for you to accumulate shares of that as a low average as you can and just hold the shares, right? What if you can't sell the contract? yeah, if you can't sell a contract, like I said, right, before the expiration date, it's going to expire worthless. Okay. All right. So that's break-even price. Now, I don't want to confuse you guys. This is actually not relevant for you guys since if you're just getting started, right? For day trading, you don't have to worry about break-even price at all, right? You only want to care about break-even price if you ever in your career decided to exercise an option contract, right? To buy the shares, then this is relevant for you. If you're just day trading and swing trading option contract and you don't not exercising your contract, you don't have to worry about break-even price. Okay, that's the last point here. Break-even price is only relevant if you intend to exercise the option. As options traders, we will exit our position for a gain or loss before expiration date. All right. What if you're auto exercised? Yeah, if you're auto exercised, you're going to be just getting the shares, right? So that just means that your broker has decided that this is a contract that's worth exercising, and that's why they have exercised it. Okay. Anyway, so I spent some extra time than I wanted there, so I'm going to move on now. Okay. All right. So now we're going to come to the more fun stuff and practical stuff, right? So we're going to learn about the different types of options, right? So there are two types of options available: call option and put option. All right. So call option gives the buyer the right, but not obligation, to buy shares of the underlying security at the strike price specified in the option contract. Ryan, if you're still lost, don't worry. This recording is going to be posted in 24 hours and you'll be able to watch it again and again until you get it. All right. If you have questions, just tag me on the chat and I'll answer a question. Okay. This is, you won't understand some concept from the get-go, but you can always rewatch and learn. Okay. All right. So call options. Call option gives you the right to buy shares of the underlying security at the strike price specified in the option contract. Okay. And when investors buy call options, remember, what did I tell you? They believe that the stock price is going to go up by a certain amount by expiration date. Okay. Investors will be able to profit or secure profit by selling the option contract if the stock moves in their favor. That is what we do in options trading. When we think that the stock is going to go up, our premiums go up as well. So if we buy something for $100 and the stock moves in our favor, we can sell it at $150 to another buyer and secure $50 profit. Okay. So that is options trading. We're trading the option contract itself, right? We're buying something low and we are profiting off of the premiums, right? Second option is investors will also have the right to exercise the call option contract and buy shares of the underlying security at the strike price specified in the contract. All right. So this is the exercising of the contract, which is what we discussed in the last slide. All right. Yes, profit from trading the contract. How is the premium moving? Does it move in a specific way? It does move in a specific way. We'll go over how premium moves when in lesson number 6 when we talk about Greeks. Okay. All right. So let's take a look at a call option example. All right. So let's say you bought Pinterest, PINS, $20 weekly call option contract at $2, $200. Okay. So you bought one contract, $20 weekly call options. Weekly call options meaning the contract expires the same week, the same Friday. Okay. The coming Friday, every week. If someone says weekly call option, it just means that that contract expires this Friday. All right. Okay. All right. So let's say you bought the Pinterest $20 weekly call option for $200 when Pinterest was trading at $20 per share. Now, first things first, when you buy a call option contract, you stand to make money if the stock price moves up, right? So when you buy a call option, the stock price, you want the stock price to move up. Okay. All right. So let's take a look at this graph here. So the y-axis, you guys can see what the profit or loss is, the P&L, and the x-axis, you can see the stock price, right? So when you purchased the $20 call option contract for Pinterest, the stock price was somewhere around here, right? The stock price was $20 when you purchased the contract. Okay. So Pinterest, when you purchased this, it cost you $200, right? So that is your maximum possible loss. So you paid $200 to purchase this option contract. So the maximum you can lose is only $200. You can't lose more than that. You only use $200 to buy this contract. So the maximum paying for you is $200, right? You can't lose more than that. Now, the cool thing about this today's class is we're going to be very, very positive, right? So if we are buying a call option, we want the stock price to go up, and the stock price is going to go up, right? So what's going to happen is, as the stock price goes up, right? So from $20 to 21 to 22 to 23 to 24, right? As the stock price goes up, your premium also goes up. So if you bought something for $200, you guys can see that the premium moves up, right? So it goes up 100, you gain 0, 100, and then 200, right? So if you bought something for $200, it's going to be like 210, 220, 230, 240, 250, 260, 300, 310, 350, right? Now, as the stock price keeps going up, the premium that you bought is also going to move up. Remember, options are derivative instruments. If the stock goes up and you have a call option, the premium of that call option is also going to go up with the stock, right? Now, as an options trader, you will start seeing profits as soon as the stock starts moving in your favor, right? The stock moves up, your premiums will move with it. You can sell your contracts and secure profits at any given time. So this is the number one question that I get asked. Do you have to wait until the expiration date to sell your contract? No, you do not, right? You can sell it whenever you want. So sometimes if you're in the chat, we sell contracts within seconds, right? So we scalp at the open. We get in a trade. We sometimes even we have done for the day by 1 minute, right? So we get in a trade and we sell within seconds to minutes to a few minutes to a few hours. Or you can even sell it on the expiration date, right? So whenever you want, you can sell your position. That is the beauty of it. If you think that the stock has run its course, if you think that the premium boost is good enough for you to take profits, you can sell it immediately and book your profits. Okay, so that is the good thing. So if the premium moves in your favor, sell it whenever you want and secure your profits. So in this case, you bought it at $200. If you think the stock option contract has moved to $250, you can sell it. All right. For exercising option contract, the break-even price is 22 in this case, right? So $20 is the strike price. Is the strike price here, and $2 is the premium paid. So 20 plus 2 is 22. So once the stock breaks about 22, you can feel free to exercise this contract because it's going to be above break-even price. So I get a question here. All right, what is the minimum time to hold a contract before you can sell? I believe I answered that question. You can sell whenever. You can sell it in seconds, you can sell it in minutes, it's up to you. How far do you purchase an option contract? So that is a loaded question. I'll answer that. We'll answer that question later on. So it depends on the option strategy that you're using. You have to pick your expiration date accordingly. Okay. The minimum is a week, but you can buy contracts as far out 2 years. Yeah, you can buy it. There are leap contracts. You can buy a contract expiring next year or if a few years from now. That's up. There are different expiration dates based on the different strategies. Yeah, you don't take any losses other than the premium paid. So if you pay $200, if you decided to be very stubborn and not follow any risk management or cut losses, the maximum you can lose is $200. You cannot lose more than that, right? All right. What is the point of exercising a contract when you can just sell it for a loss or profit? If you want the share, so in this case, if I want to buy Pinterest shares, right? If I want the Pinterest shares at an average price of $20 per share, right? Then I would, that is the need for me. That is the reason for me to exercise the contract. If you want the shares itself at the strike price, that's when you exercise the contract. Okay. Remember the GME example, right? Roaring Kitty. He had $13 GME call option. GME's current price is $160. So he wants to buy that call option, the shares at a very cheap price. That's a reason for him. That's a reason for you guys to exercise a contract as well. Okay. Does everyone understand what a call option is? Right? You buy call option when you think the stock price is going to go up. You can sell for a profit whenever you want and book. That's what we do in day trading. Okay. Next is put option. Someone asked me a question like, what is a put option, right? The cool thing about trading options is you don't always have to bet on a stock to go up, right? You can actually make money when the stock is falling, right? Put option gives the buyer the right, but are not obligation to sell shares of the underlying security at the strike price specified in the option contract. Investors buy put option. They believe a stock price will fall by a certain amount by the expiration date. Investors will be able to profit by selling the option contract if the stock price moves in their favor. That is what we call as option trading, right? So if you buy a put option contract, you're betting that the stock is going to go down, right? And you can if the stock moves in your favor, if the stock actually tanks, right, then you can make money. And then just like call option, you can sell it to another player in the market and make money, right? Investors will also have the right to option to exercise their put option contract and sell shares of the underlying security at the strike price specified in the option contract. Both call and put options are available as stock options, index option, future options, and currency options. Now, options in general, right, is just a derivative instrument. So we are used to trading stock options and sometimes index option. But if you're trading the future markets or the currency markets like Forex or whatever, right, derivatives are available in those areas as well, and you can trade them as well. The same concept applies over there as well. Okay. So let's take a look at a put option example here. Now, let's say you bought Uber, UBER, the car company, right? $40 weekly put option at $3. Okay, so you paid $300 to purchase one $40 put option for Uber, all right? And Uber was trading at $40 per share. Okay, now, so Uber, when you bought it, you paid $300 and Uber was trading at $40 per share. So the maximum loss you can incur is $300 because that's how much you paid to purchase that option contract. Okay. Now I'm going to ask you guys a question. So when you buy a put option contract, you want the stock price to go down, right? I want to make sure you guys are following. So when you buy call, you want the stock to go up, and you buy put, you want the stock to fall down. So currently Uber is at $40, right? Look at it. Uber drops to 39. It drops to 38. It drops to 37. It drops to 36. It just tanks. Let's say Uber, they did a major mess up and some bad news drops. Uber tanks. You bought a put option, and as the stock price drops, your premium is going to shoot up. So when you bought it, it was at $300. So it's going to be 310, 350, 380, 400, 450, 500, right? So as the stock keeps tanking, if there is bad news, if the sentiment in the market is down, right? For example, today everything was down, right? So we only played put option in the chat today. So everything was going down. So we just bet on the stocks to go bought put options and capitalized on that in the chat, right? So we played Amazon, we played BA, we played SQ. Someone just said, right? Roku, we played a lot of rejects or put option. So as the stock keeps falling, the premium is going to shoot up. And like I said, as an options trader, you will start seeing profits as soon as the stock price starts moving in your favor, and you can sell your contracts and secure profits at any time, right? Okay, so that's a good thing. Call option, you bet on the stock to move up, you profit then. Put option, you bet on the stock to go down, and you profit there as well, right? So the break-even price in this case is 37 for Uber. Just $40 is the strike price, $3 is the premium paid, 40 minus 3 is 37. So if you ever decided to exercise Uber and sell your shares for a better strike price, make sure that the stock is trading below 37. Okay. At an expiration date, if Uber is trading at $34 per share, you stand to profit $300. Okay. All right. So does everyone understand on a high level what call and put option is? I want to make sure. You guys can always rewatch the lesson, but it's a fairly easy concept. Call is betting the stock to go up, put is betting on the stock to go down. Okay. All right. So now we're going to talk about something unique. ITM, ATM, and OTM strike prices and options. So I told you, right? Strike price is the price where you would complete the transaction. So in this case, we bought a $40 call option. We bought a $20 weekly call option, right? So those are what we call as strike prices. And there are different types of strike prices. Okay. So the first things first, this image that you see on the screen here, right, is what we call as an options chain. Okay. So this is actually taken from a website, but if you open your brokerage app, you will see a same format. Okay. This is what we call as an options chain or options matrix, right? So the example here is Baidu, BIDU. It's a Chinese stock. All right. The stock price is currently at 105. Okay. It's trading at 105 on 4/17/20. That's last year. All right. So stock actually doubled now. It's trading about 200 Baidu. All right. So on the left side, you see all the call option. On the right side, you see all the put options here, right? So let's see what the different strike prices mean. First one is in the money options. The call option is considered ITM or in the money if the current price of the stock is greater than the strike price. Okay. So you guys can see I have highlighted these set of strike prices, right? You guys can see all the strike prices here. You have 97, 97.5, 98, 100, 102, 103, 104. The current price of Baidu is 105. The stock price is if all the strike prices that are below the stock price, right? So every one of these strike prices, right? It's below the stock price. Everything is below 105. So that's why we call these as in the money, right? So there is actually another reason for calling this as in the money, right? Think about it this way. When you buy a call option contract, right? And let's say you decided to exercise an option contract, you will only exercise it if you think that you're going to get some value out of it, right? Think about it. So if you buy, let's say you have the $100 call option contract, okay? And current price of Baidu is 105, right? So if you exercise this $100 call option, you have the right to buy 100 shares of Baidu at $100 per share, right? Baidu is at 105. You have 100 shares at an average price of $100, right? What that means is your option contract is already profitable. So if you exercise this option contract, they have some intrinsic value because the current price of the stock is way higher than the strike price. Okay? Does everyone understand that? If you exercise this contract, it's already going to be profitable. All right? That's why you call this intrinsic value, because they are already profitable. Now, take an example here, $110 call option. This is what we call as out of the money call option, right? So if I choose something like this, right, 110, if I think about it, would you exercise such an option? The current price of the stock is 105. Why will you exercise a $110 call option that is paying $5 over this is so far out of the money? You could just buy the stock price at a regular market price and you would be profitable, right? $110 is so far out of the money. It's a future price. The stock has not yet gone to that price, right? So that's why we call it as out of the money, but I'll go over that in the next slide. Okay. In the money call options are already profitable because they have intrinsic value. Okay. All right. Same thing for put option as well. A put option is considered in the money if the current stock price is lower than the strike price. Think about this here. 106, 7, 8, 9, 10, 11, 12, 13, 14, 15. These are called as in the money put option contracts because they are already profitable. Think about it. What is a put option? Put option gives you the right to sell shares of the stock at the strike price specified, right? So if you have the $110 put option for Baidu, right? The current price of the stock is 105. That means that your option contract is $5 in the money and you have the right to sell Baidu at $110 per share, even though the stock price is 105. Think about it. You have 100 shares of Baidu. You can sell it at $110 per share instead of the current market price of 105. So you can sell it for a much better price than the current market value. And that is why we call this as in the money put option. Okay. These in the money options are already profitable based on the current price of the stock. Okay. So that's why they have intrinsic value. Okay. Now, at the money call option, at the money options in general, a call or put option is considered at the money if the stock price is the same as the option strike price. So the stock price is 105. 105 here is what we call as the at the money strike price. So these strike prices are at the money. Okay, like the name implies, the stock price is the same as the strike price or in and around the same price. Okay, does everyone understand these two concepts, in the money and out of the money, at the money? Now you may ask me, what strike price should I choose? If I'm going to trade options, should I choose in the money or should I choose at the money? Those are very, very good questions. And I will answer your questions on lesson number 6 when I go over the Greeks, right? Because Greeks is what's going to tell you how these different types of options are going to move, right? So that's what's going to help you determine which is best for your strategy. The next is out of the money option. Out of the money options, a call option is considered out of the money if the current stock price is lower than the strike price. So in this case, like I mentioned, right, the green ones are out of the money because they are future price. The current price is 105, 106, 7, 8, 9, 10 are future price. You think that the stock may go there, right? But the stock is currently not there yet. So these are future prices. And that's why you guys can see right over here, the last price, this is a premium column. So you guys see here, right? This is the option premium. You guys can see that at the money option, it costs $252, $2.52. in the money options are more expensive because they're already profitable, right? That's why these options are a lot more costly. But if you go further out of the money, right, you guys can see that these are very, very cheap because the market does not value them very highly because the probability that the stock gets to this number, right, gets to this strike price is very, very low as you go further out of the money, right? That is why you see that the premiums, as you go more and more out of the money, it gets smaller and smaller, right? A call option is considered out of the money if the stock price is lower than the strike price, and a put option is considered out of the money if the current stock price is greater than the strike price. Okay, so out of the money means future prices. The current price of the stock is it's already better than the strike price of the option. But intrinsic means, ITM means the current the stock the option is already profitable, meaning the current price of the stock is way above the strike price that you have, right? So those are the differences in terminology. Today's lesson, I just want to give you guys the terminology. I don't want you guys to know what this means, why, when this is used, and all of that. I just want you guys to know what in the money means, what out of the money means, and what at the money means. All right. So make sure that you rewatch it and try to make sense of it. All right. Okay. Why are they last price for some of the put option with less likely price lower than some more? Wait, what? I don't understand that question. So the out of the money options, right? They, as you go further out of the money, they're going to be cheaper. So in this case, further out of the money is for put option is above, right? So you guys can see 105 is the current price. So as you go further out of the money, the premiums are going to be cheaper. All right. You got to go the other way, other direction. All right. Okay, well, let me see. Oh, this one, I don't know. It must be an anomaly. So you guys can see the volume on these contracts are not, pretty good. So that's why this is probably an anomaly, right? John, you are right. This is supposed to be, in the right way, but this is probably just an anomaly. All right. No, it's you've got a right question. Good spot. You guys are paying attention. I'm very, very happy. All right. Hope you guys understood what ITM, ATM, and out of the money stock options mean, strike prices mean. Now we're going to come to the last portion of today's lesson, that is options writing. Now, before I get started in this part, I'm going to tell you, you guys are not going to understand options writing. If you've never heard of it before, you're not just going to understand it from the get-go, but I'll try to make it as simple as possible so that you guys understand this. Okay. Now, please feel free to rewatch this lesson. This is not something that you need to know to get, for you to understand the other parts of the lesson that we're going to cover in future AMU, right? All right. Now let's get started on writing or learning about writing options. So what is options writing? Options writing is a strategy where an individual writes or sells an option contract to a buyer in the market to collect the option premium or fees. So remember the first slide, I told you that a financial transaction, right? A financial instrument, there needs to be two players. One is a buyer and another one is a seller, Barry and Sam. You guys remember that, right? So someone has to create that contract. You as an option buyer, you may buy option contract, but someone has to create that option contract in the first place, right? So that someone may be a market maker, it may be a big hedge fund, it can be me also, right? Even I can create an option contract if I want to. When someone creates an option contract, right, they have the right to collect the option premium and fees. So if I write Tesla $800 call option contract, right, I can collect whatever the premium is. So if that's the $800 call option costs $10 or $1,000, I can collect that premium. All right. So that is what we call as option writing. You're writing a contract and you're collecting the premium. When an option writer writes an option contract, they are obligated to buy or sell, depending on the type of option, the underlying security at the strike price, should there be an assignment. So someone asked me a question. What if they force me to buy or sell an option? They won't. If you're buying options, they will not force you to buy anything. Remember the definition. Option gives you the right to buy or sell something. It's not an obligation. The obligation goes to the option writer. If you write option and that option expires in the money and someone decided to exercise their option, then you will be assigned as an options writer and you'll be obligated to buy or sell depending on the type of option. Does everyone understand this? I'm going to quickly recap. There are two sides to a transaction. Option buyer, that is what you and me do every single day. We're going to buy option contracts. We're going to sell option contracts. We're going to trade the option contract itself. But there is someone out there. It can be a market maker. It can be a hedge fund that creates that option contract in the first place, right? They're going to create that option contract and they're just going to collect the premium. That is an easy money for them because those guys own lots of shares. They're going to write option contract to make money just like that, right? So if someone out there gets assigned, right? If you write an option contract and you get assigned, you are obligated to buy or sell depending on the type of option. So if you have a call option contract, you have to sell shares of the underlying security. If you have a put option contract, you have to buy shares of the underlying security. Okay. So this is the whole classification. Options. So far in the first lesson, we've talked about buying options. You buy call option when you think the stock price is going to go up. You buy put option when you think the stock price is going to go down. We are all of us are clear in this part, right? Now we're going to learn about writing. Writing is actually creating the contracts itself, right? You can write a call option, you can write a put option and simply collect the premium for doing so, right? If you get assigned, you will have to fulfill your obligation. It's that simple, all right? You may not get it, but this is a very easy concept. I think I did a pretty good job of explaining that. Does everyone understand that? All right, good. All right, now let's go over some examples. All right. So writing call options. Remember, when writing call options, the writer collects the premium and agrees to sell shares of the underlying security at the strike price specified in the option contract, should there be an assignment. So you're writing calls basically. So when you're writing calls, as an options writer, your only goal is to make sure that that option contract expires worthless, right? You have to think like a market maker. If you're like, these guys are writing all these contracts because they don't want to get assigned. They think that they're not going to get assigned. They think that they're going to just simply collect the free money, right? For example, GameStop, when it was trading at 400, right? People were like, all these guys, right? Big funds and everything. You think that they were all losing money, but lots of smart players who had shares, they were just writing option contracts for a crazy premium, right? $1,000 calls were going for like $500, $600 per contract. There was no way GME was going to go to $1,000, right? So that was basically free money because all those contracts expired worthless and they collected the premium. Market makers collected the premium, right? So as an options writer, seller has the obligation to sell the stock. You want the stock to depreciate in value. So if you write call option, you want the stock to go down and expire worthless, and you collect the premium. Okay, so those are the three conditions here. And if you're the buyer of a call option, that's what we discussed. When you buy a call option, you have the right to buy the stock. You want the stock price to go up, and you pay the premium. Okay, so let's take a look at this example. I think after this example, everything will be clear for you guys. Okay, so Apple naked call. All right, so let's assume John. All right, John wrote Apple $300 call option contract expiring 5/15 and received a premium of $400. So when John wrote this contract, right, what he's essentially betting, right, is that there is no way in hell Apple is going to go above $300 by expiration date. He is betting that Apple is going to stay below $300 and expire worthless. All right, that contract is going to expire worthless. Does everyone understand this first point? John is basically, when he writes a $300 call option contract, he's betting that there is no way Apple is going to expire in the money. He's betting that Apple is going to expire under $300. Okay, and the expiration date is 5/15. So when he wrote those contracts, he got a $400 credit. He received $400 to write this option contract. That's what he did as an options writer. Okay. Now, if you write one contract, you make $400. But if you write 10 contracts, you make $4,000. You guys can see how this is a very nice opportunity, right? Now, if you have a portfolio full of Apple shares, right, you can simply write call options and make money, residual income, right? That is the beauty of this. Okay. Now let's see how on the expiration date what happened. On 5/15, Apple closed at 310 in the money. So John made a bet that it's going to stay under 300, but market said, "Hey, joke's on you. Apple actually rallied and it expired in the money. at 310, right? So since it expired in the money, someone out there is almost certain to exercise this contract. So John is obligated to sell 100 shares of Apple at the strike price, that is $300 per share. Okay. Now, John, since this is a naked call option, I'll explain what naked and covered means. But naked call option means you don't have the shares to fulfill this obligation. So what John will have to do is John will have to go back to the market and buy 100 shares of Apple at current market value. Okay. So John has to go to the market, buy Apple shares at what, 310. 310 is the current price of the share or the stock. So he purchases 100 shares at 310 and he sells it. Okay, so 310 minus 300. So he buys Apple at 310 per share, 100 shares, and he sells it at 300 per share based on the option strike price into 100, that's 100 shares. So John will lose basically $1,000, right? So John will lose $1,000 on this transaction, but John initially received a credit of $400. When he wrote the contract, he received $400. So 1,000 minus 400, he lost 600 on the trade. Okay. So this is assuming the option expired in the money. But scenario 2, if you actually think about it, most of the, like this is an actual stat, I'm not even making this up. 90% or 99% of the contracts expire worthless, right? Most of the highest open interest contract by statistic expire worthless. Market makers make sure that they expire worthless, right? So in scenario 2, if Apple closed at $298, below $300 on 5/15, then there is no assignment, there is no obligation to sell shares. Those option contract will simply expire worthless, and John just made a profit of $400. Okay. Does everyone understand this? So if you wrote an option, you collect the premium. If it expires in the money, you will be forced to fulfill that obligation, right? Depending on where the stock is at, you may lose a certain amount. Okay. Now, differences between naked and covered call option writing. Writing naked calls is a strategy of writing a call option without owning the underlying security. If you don't have the stock, you have to go to the market and purchase the stock and settle that assignment, right? The risk associated with writing naked call option is infinite because stocks can technically go to infinity. There is infinite upside potential. Now, let's say you decided to bet against Elon Musk and you write insane amount of call options, $700 call options, $800 call option, and Tesla has earnings next week. And there's a big gamma squeeze, big short squeeze, and Tesla stock went to 1,000 or 1,500. I don't know, something crazy, like let's say they solved world hunger or something, right? You never know with Tesla, right? If they did something like that and the stock rallied, your upside potential is infinite and you'll have to buy the shares at current market value. And you can view potential to take a big loss if that happens, right? So that is why it's risky to write options naked because you don't own the shares. So it's risky because the stock can technically go to infinity. Writing covered calls is a strategy of writing a call option while owning the underlying security. Now, if you have the share already, you can just simply sell the shares to complete your assignment. Okay, that is a risk-free strategy. That's what a lot of market makers do. They usually do covered call options writing. Okay. All right. Now, writing put options. What if you can't buy all the shares on a naked call? What if you can't buy all the shares of a naked call? So to write options, you need a margin account first. If you cannot fulfill that obligation, your brokerage app will not allow you to write that option. They will say that there is a margin error. Okay. So only if you have the necessary capital can you actually do options writing. All right. Writing put options. Writing put options, the writer collects the premium and agrees to buy shares of the underlying security at the strike price specified in the option contract. Okay. So let's see this example. Suppose John writes NVIDIA $300 put option contract expiring 5/15 and collects a premium of $5. Same concept. Okay. If it expires in the money, John is obligated to buy 100 shares of NVIDIA at $300 per share, assuming John is assigned. If it's in the money, you guys can see the math here. 300 minus, that's the strike price. 290 is the spot price, the current price of the stock. So minus is $100, $1,000. Initially, he received a credit of 500. So 1,000 minus 500. John lost 500 on the trade. Scenario 2, if the option actually expires worthless, then there is no assignment. John simply made a profit of $500. Okay, so this is put options. All right, same thing. If it expires out of the money, you simply collect the premium. If it expires in the money, you have to fulfill your obligation and buy shares of the underlying security at the strike price. Okay. Now, writing naked put involves writing put option without shorting shares of the underlying stock. The risk associated with this strategy is high should the option not expire worthless, as technically the stock can go to zero before expiration date. A good example is, so let's say John wrote Hertz $10 put option contract. Okay. Now, everyone, I don't know if you guys know this, but Hertz filed for bankruptcy earlier this year, right? Earlier last year. And the share actually dropped to $1. So what this means is John wrote $10 put option contract and Hertz dropped to $1. It expired in the money. So to fulfill this obligation, John will have to buy 100 shares of Hertz at $10 per share. So the risk with this thing is you actually buy the share. That is cool. But this is a bankrupt company, right? So there is potentially the stock is a very low chance of this ever recovering back to $10. So basically you have a stock that you bought for $10 and the current value of the stock is $1, right? So this is naked put option writing. It's not as bad as call options writing because the upside potential is to infinity, but for naked put option, the downside potential is to zero. Technically, stocks can drop to zero, right? But you don't have to face this problem for good companies. For example, if you wrote a naked put for Apple, the worst thing that can happen is you'll be forced to buy shares of Apple, and Apple is a good company and a good hold, right? So even if you wrote that option, you can collect the premium and buy the shares of Apple and hold it. Sooner or later, you'll be able to sell it. Okay. So it's not as bad, but you have to be very careful on what companies you write the naked put on. All right. So what is a covered put option? Writing covered puts involves writing of put options while shorting shares of the underlying stock. So a lot of you will not know what shorting means. So I'm going to explain it to you as briefly as I can. Shorting means borrowing shares. Okay. You're borrowing shares from your broker or someone else, right? Basically someone else. You're getting that loan from someone and you're betting that the stock is going to fall. Okay. To give you an example, let's say Apple is trading at $100. Okay. You think that the stock is going to fall. You think that the stock is going to drop. So you can short Apple at $100, meaning you can borrow shares from someone with an average price of $100. And as Apple drops, let's say it drops to $95, right? You can cover, meaning what that means is you can buy back the shares of Apple and return it back to them. So you will basically profit the difference. So you shorted at 100, you borrowed at 100, and you returned at 95. Okay, so $5 difference is what your profit is going to be. Does everyone understand that? What shorting means? You're basically borrowing at a higher price and covering at a lower price, and you're profiting the difference. So that's why when Simon says there's a big short seller out there, what they're essentially doing is they're betting the stock is going to go down. Excuse me. You're borrowing high and covering low. Okay, so covered put involves writing of put options like we just went over, and it also involves shorting shares of the underlying stock. So you're doing two things. You're writing put option and you're also shorting shares of the underlying stock. Okay, let's go through this example. Let's assume that AMD stock is currently trading at $45 today. Okay, AMD stock price is 45, and John writes a $45 put for a $200 credit. Okay, so when he wrote $200, when he wrote this $45 put, he received a premium of $200. Step number one is complete. Step number two is John also decided to short 100 shares of AMD stock at $45 per share. He borrowed 100 shares of AMD at an average price of $45 per share. Now the strategy is complete. Okay, the net credit taken to enter the position is $200. So that is the premium that he received. That is the credit that he took. Okay. Scenario number one. AMD is trading at $40 at expiration. So AMD, you wrote the put option contract, and AMD, unfortunately, it dropped and expired at $40 at expiration date. The short put will expire in the money, meaning your put option that you wrote is now expiring in the money and is worth $500. So you will have, your position is currently down 500 because your option expired in the money. How I got this 500, you may ask me. Just simple math, right? 45 is the current price of the stock. Sorry, is the strike price of the stock. Current price is 40. 45 minus 40 is $5. 5 into 100, right? 100 is the fixed lot size, right? One contract is equal to 100. So 1 into 5 is 500. 100 is 500. Okay. So the cool thing is this loss is offset by the $500 gain in the short position. You also shorted AMD shares at $45 per share. So basically, this is like a protection. Think of this like insurance. The shorting position is like insurance for you. Since you also shorted shares of AMD at $45 per share and current price is 40, you made $500 in that short position. So basically, the profit is still the initial credit of $200 taken. Does everyone understand that? Your options expired in the money. Since you wrote options, it expired in the money. You took a $500 loss there. But since you also shorted shares of AMD at $45 per share, right? Your loss was offset by the $500 gain made in the short position. All right, Vanessa says she does not understand. So covered put option writing essentially has two components to it. You're writing the put option like you used to, but you're also shorting shares of the underlying stock. Okay. Shorting means you're borrowing shares at a higher price and you're covering low, right? You're basically profiting the difference. Okay. This example here, AMD $45 put option is what you wrote, John wrote. He received a credit of $200. He also shorted 100 shares of AMD at $45 per share. Okay. Scenario number one, AMD is trading at $40 at expiration. Okay. So the short put will expire in the money because it's expiring in the money, $40. It's down $500. But since John also shorted 100 shares of AMD at $45 per share, he can cover that position and make $500 gain in that position. So basically 500 and 500 cancel each other out. And he made a profit of $200, which was the initial premium that he received. Okay. This is scenario one. Scenario two is AMD is trading at $55 per share at expiration. So in this case, all right, AMD is at 55. So the put option that you wrote, since this stock went up, right, will expire worthless, and John can simply take the $200 credit. But unfortunately, John also shorted 100 shares of AMD at $45 per share. And as the stock price goes up, right, he's going to take a loss on the short position, right? So think about it. The stock is at 55. He shorted at 45. So 55 minus 45 is $10. 10 into 100 is $1,000 loss, right? For the short position. Subtracting the initial credit taken, the resulting loss is $800. Now, I'm going to give you guys a trick here. John does not have to wait until $55 to cover his position. If John feels like the stock is going to expire worthless from a common sense point of view, right? He could have just simply covered it at $50 or $48 or $47 whenever to minimize the losses, right? He does not have to wait for $55 to cover a short position. He could have covered it at a lot sooner and just made it into a naked put, right? Basically, covered put option, you can short the share position anytime you want. You don't have to do it at the moment you open your option contract. Okay, you can add the short position when you feel like you need the protection. Does everyone understand that? The short position can be added at any time. It's basically like insurance. You've written some option. This is something market makers do all the time, right? How difficult is it to short stocks? You need a margin account to short stocks, and some stocks may be hard to borrow. So it depends on that. But basically, all the major stocks you can borrow and short pretty easily. Okay. All right. Last slide. We're almost there. Why do we trade option? First point, to generate incomes through options writing. So if you have a big portfolio, you can a lot of shares you own, you can definitely write some covered call options, right? And make some money. It won't be glamorous money, but 200, 300 a week, 400 a week, 500 a week is definitely good money. And trust me on this, a lot of big guys with big portfolios, they only do options writing. They make a killing in the long run, because the more money they make, this residual income, they simply buy more stocks and they just keep building their portfolio on and on and on. And that's how these guys become very, very rich, right? The bigger portfolio you have, the more you can do options writing. It's a safe strategy to make some small money, right? The next is to hedge your portfolio against major events like earnings, elections, etc. So if you have a big portfolio, right, and you see some big event, so Biden versus Trump elections happening, you don't know where the stock market is going to go, right? So in those cases, you can buy some put options and as a hedge, right? If the market crashes, you can simply exercise your put option and sell your shares at a better price, or sell that premium to offset some of the losses, right? So options can be used as a hedge against major events like elections and earnings. Okay. And next, return on investment is higher when trading options. Higher percentage of return for a smaller move in the underlying security. So to buy 100 shares of Apple, you need a whole bunch of money, right? You need like $10,000+ to buy 100 shares of Apple. But to buy one option contract, right, you don't need that much money. You probably just need $100, $200. And if you're buying equity for $10,000 for every $1 move, you're only making $100 when you're buying equity, right, for 100 shares. But when you're doing options, right, you're only spending $125. And if Apple makes a decent move, you can make a much higher percentage on that investment when trading options. So that is the main advantage of option. If you're having a small account, you can, and you follow good risk management, you can easily grow your account by trading options. You don't need that big capital to grow your account. And the next is the maximum loss is capped when buying option. You only lose what you paid in premium, right? So the same thing applies. If you have $10,000 worth of shares of a company, and the next day the company goes bankrupt, your $10,000 goes to zero, right? So that is a bad thing about equity, but that does not happen frequently, but it is possible. But if you just hold one put option contract that's worth $200, the maximum you can lose is $200, right? So you somewhat can make a lot of money, but you don't lose a lot of money as well when you're trading options. You only lose what you paid in premium. So these are some of the main advantages of options. And as a day traders, like you guys know, we buy low and sell high. We try to profit off of the premium, and that's the beauty of options. All right. That's all I have for you guys today. Hope you guys enjoyed this lesson and found it interesting. Now it's time for questions. Thank you.
Do you guys have any questions for day one?
Is it common for penny stocks to have options? No, penny stocks usually do not even have an options chain. So most stocks listed in major indices only have options. Those penny stocks usually aren't listed on the major indices like NASDAQ, New York Stock Exchange.
Gerald, no, when you write a call or put, you don't have to wait because it's market maker's job to provide liquidity. So
Yep.
if you're selling a contract, then someone has to pick it up if you're selling it at the bid.
Yep. Do you advise exercising your contracts? If you think that makes sense for you in the long term, it's an investment decision, then you can exercise your contract. Are options writers buy options it shows in Flow Algo? No. The ones that you see on Flow Algo are just option buys, strictly buys. So someone out there is just buying a large amount of option contracts.
I follow you guys, scalp calls. Seem like you guys international in the first 15 minutes. Sometimes first 5, which goes quick. Does Lightspeed and Thinkorswim really have the degree of difference in fields? Yes. Mike said Lightspeed is faster.
Yeah, they're both really good platforms.
So Daniel asked me a question. So if I get a put option contract and the stock goes lower than the strike price, do I have to fulfill that contract? you don't have to fulfill it if you're just buying the option contract. So when you're just buying, think of it like trading. You're buying an option contract, you can sell it to someone else and make profit. All right. You don't have to fulfill anything. You don't, unless you're writing that option contract.
For Canadians, I recommend Interactive Brokers.